The future of crypto lending. Yet another original idea stolen from the traditional finance markets, but this time with a crypto twist. Let's see if they actually learned any lessons from the traditional finance markets.
Celsius filing for bankruptcy definitely wasn't a surprise. I mean, once a platform suspends withdrawals for customers, freezing all of its users' crypto cash, it is typically all over. But just because this wasn't a shock doesn't mean that it wasn't a really big deal for the industry. Celsius was once one of the largest players in the crypto lending space.
The collapse of one so-called stable coin known as Terra USD has shaken investors' faith in crypto.
Owes Voyager more than $650 million. This is a lender and also sort of a brokerage firm. What does it mean that they're filing for bankruptcy protection?
So the gist of that was that basically one person loaned to another person, which then loaned to another person, which loaned to another person, and so forth. It's actually quite a long list of people that was caught in that contagion. But when that end person who took that loan can't pay back their debts, they default, which then causes a domino effect because then that person who they borrowed from can't pay them back and so forth. So why do I have a bone to pick with this? Well, there's a lot of reasons, mainly the marketing of it. The whole idea of getting a higher interest rate than what a traditional bank would give you is the main allure of doing something like this. But what they don't highlight, or what gets downplayed massively from what I've seen, is the risk portion of it. Stuff like, I mean, you heard it in the first clip there where she said that when this company went down, they seized your coins. They're not yours because, well, possession's 9/10 of the law. And honestly, don't think for a second that any of your assets in Coinbase are safe as well. This isn't a far cry from the real world because a bank, for instance, will take deposits from individuals such as yourself and issue loans out. But that's also where it kind of splits off as well, because the process is somewhat the same, but the protections isn't. Because if the bank loses your money, it's insured, or FDIC insured, up to $250,000. Meaning if you have $300,000 in the account, you'll be reimbursed up to $250,000, resulting in a net loss of $50,000. But again, there's always loopholes to things, and this is the wording of the law is basically per account ownership. So you could have it at one bank and another bank and so forth, right? It's split it up amongst each other under 250K. Not financial advice, by the way. But in crypto, you basically have none of that safety net. In the traditional world, some loans will require you to put up something worth more than the loan. Typically, it's your house or something like that, right? But let's say, for example, it's your house. If you default on that loan, the loaner will have the legal ability to seize your house, to basically sell back on the open market to recoup some of their losses, if not all of them. However, on the crypto side, there's not exactly any physical assets they can seize. You merely put up some coins as stake collateral. Now, this can be wildly unstable, since given the nature of crypto, since the facilitator isn't taking a direct stake as well. I mean, for the most part, they don't care. It's the depositors, like I said in the previous example, it's them that's taking the risk. And again, because I have to reinforce this point, like some of the previous clips have said, they have the power to freeze withdrawals, meaning that you can't even get some of your deposit out. The best case scenario is that the borrower actually pays back the loan plus the interest rate. Everybody wins in that case, especially if the coins grow in value and so forth or whatever, right? But it's asking a lot, and I'll let you make up your own decisions, especially looking at the failure rate for businesses according to LendingTree. This transitions me to my next point, which is irony, because in the traditional finance world, you're assessed based on your credit worthiness, aka your credit score. If you're diligent in repaying your loans, you're allowed to take out larger loans, basically under collateralization, stuff like that, because you were responsible with your finances. Can you imagine hitting that subscribe button and leaving a like on the video, but also your bank loaning your hard-earned money to people that couldn't qualify for these loans traditionally because they have no track record of ever paying back the loans? This is what crypto aims to disrupt. They want to issue loans for everybody, even the ones that are not credit worthy enough to get a traditional loan, using your crypto that you loan to them. And to mitigate this default risk, apparently they're finally starting to do this now. They're starting to add things such as, third-party risk assessment, which is basically people that will go look through your on-chain history and determine your repayment and credibility, which will also lead them to build your native crypto score using your on-chain history, looking at the wallet repayments of loans, staking, and trading activity. It's basically the same. So let me get this straight. Basically, all the traditional finance world's protection barriers that they put up for good reason, mind you, to preserve the quality of the loan as well as have investor protection, the crypto world is somewhat now doing. And what I find even more ironic is that although the crypto world wants to give universal access to everybody, they're taking the same rules and the same standards from the traditional finance world. So what would actually differ in terms of results if you were to go for a loan in the traditional world versus the crypto world? Because I mean, you're going to get denied the same way as far as I can see. I don't know, you tell me. One final loophole and somewhat of an ironic take from me is that in the traditional world, your social security number, it's not impossible to get it changed, but it's just incredibly difficult. You need a very good reason. It's basically inescapable. You have it for life, similar to your federal student loans. But in the crypto world, what's to stop a defaulter or previous defaulter from creating a new wallet, creating a new identity, and generating some minor activity to get their credit score up, and then applying for a new under-collateralized loan or something that they don't intend on paying back? Crypto can claim they stand for decentralized finance, and maybe they'll ask for like real-world ID to tie the wallets together and so forth because that's unchangeable. But they also kind of become what they set out to disrupt, which is decentralized finance. Do you think that maybe, just maybe, that the traditional finance world kind of has these rules, barriers, and protections for a reason, and they have it a little bit more figured out than the crypto world? And maybe it's kind of ironic that the crypto world has all this financial history in front of them, and they're not taking advantage and learning and building upon that. I don't know. You tell me, but just remember, just because you're a day trader doesn't mean you have to trade every single day.